Hi, this is Stephen from Share Navigator. It's October the 21st, and this is your option and future trades ideas for today. So, first up, we're going to just recap our existing crude oil December futures contract, the short puts that we have outstanding on those. Second, we're going to talk about USO as a proxy for crude oil. So, for those of you who don't like trading crude oil futures contracts or the options on them, you can always use the USO, which is the United States Oil Fund. Um, and we're going to show you how to do calls and puts on those too. And then we're going to have a little discussion about what's ahead for SPY and where I see things going and what potential strategies could apply in SPY. So first up, let's look at our crude oil futures contract for December. We sold the $55 short puts, and you can see we're up $131 per share. So I just want to share with you again the brilliance of the short put strategy, in my opinion, and just bring you back to when we actually first put this trade on. As you can see here from the chart, when we look at crude oil, uh, we put this trade on back here when crude oil was at about just above $60 a barrel. And if we'd have gone long on crude oil then, in other words, we wanted the price of crude oil to go up and we were still holding it, we'd actually be down quite a bit here because it's down now at 57.37. But what we did instead, we kind of hedged our bets. We sold an insurance policy at the 55 strike. In other words, what we said was, we're not going to buy the futures contract now, but if it did drop to $55, we would buy it. And we got paid like an insurance policy for doing that. And that's why we're up on the trade, because what's happened between since we've placed that, the stock has fallen, or crude oil has fallen, but the time to expiry is also fallen as well. And that's why we're in profit here. So as long as crude oil stays above $55 a barrel, our trade expires on October the 29th, we're going to make a profit in that particular trade, which is great for us. So if we look here at our position as well, I just want to explain the reason why this works, the short put strategy works. It's a thing called theta here. So if you look at the theta value here on this contract that we have, it's at $51. What this means is every day between now and expiry, if crude oil had moved from here, we would actually generate $51 in profit per day because the time value or the theta value of that option is expiring at a rate of $51 a day between now and expiry. This expires next Wednesday. So our probability of profit in this trade is now 83%. So this little tool here is from this moment on, okay? So that's the reason why we love the short put strategy. So nothing to do with this, guys, whatsoever. I'm going to move on to USO now. So some people may not be comfortable trading crude oil futures contracts. That's fine. Another way of doing it, and it's really a proxy just for trading crude oil futures contracts when you do it this way, except there's a fund manager doing it for you. This is USO. It trades like an ETF. And as you can see, the chart here is very similar to the movement in crude oil. So for example, if you wanted to sell puts on this on USO instead, you would actually get the physical assignment of USO in this case, and you could do that. So let's have a quick look at the contracts, the option contracts for USO. I'm going to just come from the call option perspective for now. So if you were bullish on crude oil, you thought the price was going to go up, you might look at buying a call option instead. Okay, so first things first, with call options, time frame, we like it 90 days or more. And the reason is because of theta. The closer you get to expiry, the value of theta increases. And when you own an asset, that's a negative for you because the value of it's decaying every day. The time to expiration is getting lower. And the closer you get to expiration, that time decay speeds up at a rapid rate. So that's the first rule. Go about 90 days to give yourself, to avoid this theta trap or the time decay trap. The second thing we like to do is the delta. We like the delta in and around 0.7. And the reason for that is it just gives us a better chance of winning, okay? And what delta means, again, just as a reminder, for every $1 rise in the underlying asset, in this case USO, the value of that call option will rise by 71 cents, okay? So if, for example, we bought this today, crude oil or the USO rallies by $1, this value of this then will be up by 70 cents, which will make a 10% return on investment. So this is another way of potentially trading crude oil if you like it between now and January. So we'd be looking at January 16th expiry, the $63 calls on USO if you did fancy crude oil. However, I just want to benchmark while we're here the benefits, the pros and cons of the long call versus the short put. So the benefit of the long call is your risk here is entirely limited. So if we bought this call option, it would cost us $745 per contract. Our break even is the negative. It's up higher. Our break even in this trade would be $70 plus per contract, right? So about $70.50. So crude oil needs to rise from here, and that's why our probability is lower. So the benefit of the call option is we have all that upside potential. We've a maximum loss potential of only $745. Can't lose any more than that. But the downside really is our probability of profit is lower because our break-even price is higher. So just to quickly show you what that looks like here, you can see our break-even price is $70.58. Okay, so we need USO to rise from 68 between now and January over 70.58 to start making money. Okay. Then if we benchmark that, for example, against actually, let's say we just sold the put option contract for the same expiry at the $63 strike, look what happens to your probability of profit. It's at 78%. So the benefit of the short put strategy is at 78%. Why? Because your break-even price is lower. We've basically insured the value of crude oil for a much lower price than where it's at now, this USO contract. And that's why our break even is lower. So in other words, the value of USO could fall as well as rise here, as long as it doesn't fall too much and we make a profit. So the benefit of this strategy over the long call is our probability, our chances of winning are actually higher. The downside is, look at our max loss per contract here. If crude oil went to zero, unlikely, I know. But if crude oil starts plummeting, our losses start to mount. Whereas with the call option, they're absolutely fixed and that's it. That's all we can do. So there are the pros and cons of those. Okay. Finally, just want to talk about SPY. My own view, guys, on SPY. Last week we had a bit of a wobble in the market, and it was really down to, I suppose, one factor, and that was a little bit of a credit scare with some of the regional banks. But since then, we've had a lot more regional banks report their earnings, and there's no sign of any credit issues there. So my own view is over a period of time, this market is going to continue to go up right into the Christmas period. We will have little shakeouts in between. My preferred strategy is the short put strategy on SPY, and I'd be looking at the 630, 640 strikes when selling them. So my own view will be if we get little shakeouts again, let's say SPY dwindles down to 660 or lower, maybe we sell the 640 puts on SPY out for a month and keep doing it that way. My own view is there's a chance now we're going to tip 7,000. There doesn't seem to be anything. Now, that being said, there's no doubt about it. The market is a little bit stretched, and I'll be the first to say that. However, if you feel the AI trade is coming towards an end, well, then you wouldn't apply this strategy, because if the AI trade does come to an end, the market could sell off quite a bit. On the flip side, if you think the AI trade is only getting started, I think this market is set to grind higher. And I think it's that simple, really, at this moment in time. And the only thing is, if something comes out of the blue, like a credit scare, obviously that's different. But don't forget you're invested into an index, and that's why we like selling the puts on the indexes as such. So right now, nothing to do with SPY, but what I will be looking at is selling puts on opportunities that I get. Okay, this is your market update for October the 21st. Any questions, please feel to reach out. Thanks and bye for now.